Hello everyone, thank you so much for joining. Today I would like to give you a quick introduction about revenue recognition. As you may have heard, there are two different principles. The first one is accrual accounting and the second one is cash accounting. The main difference is cash accounting reflects and records transactions when cash is received. It really focuses on the delivery and receipt of cash, whereas accrual accounting is that revenue and also costs, but revenue is recognized, basically reported on the income statement when it is earned. So the company's financial records reflect revenue from the sale when the risk and reward of ownership is transferred. So here under accrual accounting, we are not looking at cash, we are looking at transfer of risk and reward. Usually that is if you sell a product, that is once the product has been delivered to the customer. Then the product belongs to the customer and that's when a company would record revenue on their income statement. There is a more technical term just for sake of completeness. So under IFRS and US GAAP, the standards say that revenue should be recognized to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in an exchange for those goods or services. Sounds a bit complicated, but again, if we go back to the more simple definition, revenue to be recognized when the risk and reward of ownership is transferred. Yeah. Again, we are not an accounting course, we focus on finance, so that's why we leave this here. What I want to do, I want to give you an overview from 3 examples. Let's assume, and you can see it here already, let's assume we have a company and the company sells a product. The value of the product is 100. And the product is sold to a customer 1st of March 2025. So let's do the following. Let's do 3 scenarios. Scenario 1 is the customer who receives the product in March pays $50 already beginning of January and will pay the remaining one when the product is received. In the second scenario here in green, the customer receives again the value or the product in March and will pay at the same time. And then scenario 3 is where the customer would pay $50 in March and would pay the remaining $50 in May. So again, we are looking at accrual accounting. Yeah, not cash accounting. So from accrual perspective, what we are going to do is we look at income statement and balance sheet under each of those scenarios. Quickly to recap, income statement, revenue, cost of goods sold, gross profit minus SG&A, EBITDA, and so on. And then later net income, and then not really part of the income statement, but then the company can decide whether to distribute via dividends or to pay out the amount via retained earnings. Not to pay out, but to reinvest via retained earnings. Okay, let's look at income statement 1st of January. Under example number 1, receives $50. From an income statement perspective, nothing happens because we are not recognizing or recording revenue yet because risk and reward has not been transferred. So revenue would be 0. Nothing happens from an income statement perspective because we only receive cash. However, something will happen because you have received cash, so you need to record this somewhere. You can't just say, okay, give me $50, we put in our bank account, and we would not reflect this in our financial statement, so something needs to happen. So what would happen under example number 1 is that you would record a cash entry. So you would record cash $50 because you have received. And then what you would also do is you would record a liability, which is called unearned revenue 50. Unearned revenue means you have received 50, but you have not provided the service or have not delivered the product yet. It's a liability, so cash 50, unearned revenue. And once you have received, or from a company perspective, once you have delivered the product in March, then you would decrease the liability. This would be removed. There's nothing unearned anymore because in March you have delivered the product. What would also happen is when the product is received, you would recognize and record 100 as a revenue. You would also add another $50 to cash. So the cash amount sits now at 100. We have decreased our unearned revenue because now everything has been earned. And then how the balance sheet, as you can see, not yet is still balanced because the 100 revenue that you have recognized, you have collected all the money. Basically, the retained earnings, as you know, go into shareholders' equity. So indirectly, we have 100 here more or less as well. Again, not from an accounting perspective, but just to understand the concept. If we go to the second example, which is a bit more straightforward. In January, we would not do anything because nothing happens. There's no transaction. And in March, what would happen is we would recognize revenue, and then we have a cash position of 100 here as well. Yeah, and then again, retained earnings, the income statement part is basically part of your shareholders' equity. So that's how the balance sheet more or less would be balanced. If we go to the last example, we touched upon this when we talked about net working capital. Last one is in January, nothing would happen. There's no transaction at all. No cash is received. The delivery of goods has not been happening yet. So in March, what would happen under accrual accounting again? We would recognize 100, not 50. Again, we are not concerned on when cash is received. We are concerned about transfer of the good, transfer of risk and reward. So we recognize 100 in revenue. We also recognize 50 in cash. And what we do is, from a customer perspective, is we have accounts receivables of 50. Yeah, accounts receivables, this part. And then we have 100 here on the left side, on the asset side, 50 plus 50. And because we have recognized revenue on the shareholders' equity side, the balance sheet is balanced. And then accounts receivables, this is money that we hope to get in the future. Once this money is received, we will basically add another cash. So cash would go to 100 and we would decrease our accounts receivables account by 50. I hope you found this useful. Thanks so much for listening. Bye.